The country's ninth largest bank, Capital One, shocked the finance world when it announced that it'll buy Discover Financial Services for a staggering $35 billion. This all-stock deal is set to be one of the biggest M&A deals of 2024, bringing together two of the nation's credit card giants to create a true global payments powerhouse. But what drove Capital One to make this move? It's clear as day that the Berkshire Hathaway-backed Capital One has finally had enough of the sky-high fees associated with Visa and MasterCard. And by snatching up Discover, Capital One won't just compete with these industry titans, but it could also break free from their clutches altogether. After the news, Discover stock rose 15.6% in pre-market trading, while Capital One's shares fell 3.5%. But there's just one problem. The rise in Discover stock doesn't reflect the nearly 27% premium Capital One valued Discover at, which could suggest that investors aren't entirely convinced that this deal will come to fruition. To determine if this is the case, we're going to walk you through everything we know so far about this deal in this video and why Capital One is so intent on completing it. We'll also talk about the major risk facing the merger that could result in its total collapse. So don't miss out. Welcome back to PSD Markets. If you're a shareholder in either Discover or Capital One, but aren't sure of what this deal means for you, then here's everything you need to know. Under the terms of the all-stock deal, if you're a Discover shareholder, you'll receive 1.0192 Capital One shares for each Discover share you own. And what's really interesting about this is that Discover has a market cap of $27.6 billion, and the deal is valued at $35 billion, which means it's a 26.6% premium over a closing price on the 16th of February. Moreover, after the deal closes, Capital One shareholders will hold roughly 60% of the combined company, while Discover shareholders will own the remaining 40%. So, why is Capital One spending $35 billion on this deal? For starters, now is a good time for credit card companies to make big moves like this one, as there's a big boom going on in the credit card sector because more and more customers are switching from paying with cash to cards, thanks to generous rewards programs and the strong rise in e-commerce, which started to really take off in the pandemic. Additionally, card issuers are getting a boost from the increase in credit card debt, which continued to increase last year amid rising prices and declining savings. As for what it's getting from the deal, buying Discover would give Capital One a large card network that would greatly increase its power in the payments ecosystem. And this is important because card networks are essential for making transactions happen, as well as setting the fees that sellers pay when customers shop with their credit cards. This would allow Capital One to negotiate interchange fees and other terms directly with merchants, making Capital One more of a competitor to companies like Visa and MasterCard. Notably, shares in Visa are down 1.8% in pre-market trading after the news, while MasterCard stock was down 3.2%. The deal would also increase the number of cardholders Capital One will count as customers for its credit card lending business. And it's not just getting numbers, but quality too, as many Discover cardholders have high credit scores. The deal would also allow Capital One to get its hands on the consumer deposits in Discover savings accounts, an area in which it already has a large presence that it can continue to grow. When you compare Discover to competitors like Visa and MasterCard, you'd think that Discover is a very small company, but what makes it unique is that it's one of the few US card issuers that actually have payment networks, which is why Capital One is buying it in the first place, even though it uses Visa and MasterCard for most of the cards it issues. But you should expect it to switch some of its cards to Discover after the deal closes. We say some because the deal happening doesn't mean Capital One will stop using Visa and MasterCard, and that's mainly because they have a wider global reach and more recognition, and that means more acceptance by sellers outside the US that might have never heard of the name Discover. To give you a better idea, you should know that Discover currently has 70 million merchant acceptance, compared to Visa's 130 million and MasterCard's nearly 100 million. Still, this could be Capital One's play to reduce its dependence on Visa and MasterCard, as the pair have come under fire in recent years for the high fees that they charge for processing payments, and some lawmakers even accuse them of forming a duopoly. For Discover, the deal couldn't have come at a better time, as the company was going through a tumultuous period in which it experienced increased regulatory scrutiny and two changes in its leadership. The reason behind Discover's trouble is a statement it issued last year, in which it said that it had misclassified certain credit card accounts beginning in 2007 and incorrectly placed them in the highest pricing tier. As a result, the company was forced to record a liability of $365 million in estimated compensation for everyone involved. In addition to that, Discover received a consent order from the Federal Deposit Insurance Corporation, or FDIC, which had to do with consumer compliance. But Discover didn't give any more details about it. But the company ended up escaping a fine from the regulators when it reached an agreement with the FDIC and said that it would improve its compliance management system. This isn't the first time Discover was approached by a large bank or even a tech company about an acquisition. In fact, the company has been receiving offers for a decade, especially from tech companies. So why did it accept this one now? This might have to do with the fact that the tech companies that wanted to buy Discover were only interested in its payments and card network, and wanted to use it so they could play a more central role in payments. But Discover's older management wasn't interested in separating the company's credit card lending side from the network, which is why many deals were rejected. On the other hand, Capital One said that it's planning to maintain the Discover brand on the cards and network. If the deal happens, it will certainly rank among the biggest deals so far in 2024, after a slowdown in M&A activity in 2023 thanks to increased interest rates that reduced the appetite for massive deals. There's an opportunity here to create a new credit card giant, but the main concern for shareholders in the two companies can be summed up in one question. Will the new joint venture stock compete and outperform in the broader market in the long term? While Capital One and Discover have easily outperformed other financial institutions over the last 3 years, both have lagged the broader market. In that period, Capital One's stock has returned almost 15%, while Discover is up more than 17%. Comparatively, the Dow Jones US Banks Index saw a 1.8% drop. But while they're great in their sector, their performances fall short of the S&P 500's return of more than 28%. It's likely that the two companies hope that the combined company is able to take advantage of the current boom in the credit card sector, which would lead to higher profits and a higher stock price than the stocks of Capital One and Discover. Whether the new stock will be able to beat the market or not, it's generally agreed that the deal would really boost Capital One's stock. In fact, Citi analysts said Capital One getting its hands on Discover's valuable payments network will unlock value that neither company could do on its own and increase their price target on Capital One's stock to $152, an 11% upside to the closing price it had on the 16th of February. While all of this sounds good on paper, successful M&As of already big companies are super hard to pull off. Together, Capital One and Discover will become the 6th largest bank in the US, with consolidated assets of almost $625 billion, according to the Federal Reserve. With a combination like this, it wouldn't be surprising if it ends up coming under intense antitrust scrutiny, even though the two companies expect the deal to close late this year or in early 2025. But given the fact that Capital One said a shift from the duopoly of Visa and MasterCard to Discover would help it generate an extra $1.2 billion in revenue in 2027, the company will definitely do its best to overcome the complex regulatory issues. Still, regulators are likely to be more amenable with this deal, since Capital One is a well-known company and is considered a good actor, and Discover previously pledged to invest $500 million to better its compliance operations after its troubles with the FDIC. For now, we'll just have to wait and see how Capital One navigates this, and this is what makes it a good idea to hold its stock, as well as Discover's, especially since the approval of the deal could be a massive catalyst. Well, that is everything for now. What do you think? Is Capital One stock a good investment right now? Please let us know what you think in the comments below. And if you haven't, please subscribe and leave a like for this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.